Right now, if you walk into a bullion dealer in Dubai, you will pay $91 for 1 ounce of silver. Pull up the COMEX price in New York and it says $74. That is a 23% gap between what the physical market charges and what the paper market claims. And here is what should terrify every silver holder watching this. After the crash from $116, that gap did not shrink, it got wider. The East is telling you one price, the West is telling you another. One of them is wrong and the correction is coming. Now I know some of you are thinking premiums always exist in physical markets. That is true, but a 23% divergence after a 38% crash is not a normal premium. This is a structural break between paper pricing and physical reality. If you hold even 10 ounces of physical silver right now, the next 15 minutes could change how you think about what your metal is actually worth. Because by the end of this video, you will know exactly why Dubai, Shanghai, and every major Eastern buyer is refusing to reprice downward while COMEX says the crash is real. I am going to show you 3 specific data points that prove the paper price is disconnected from physical demand, the COMEX vault numbers that nobody in mainstream media is covering this weekend, and what the Shanghai premium is signaling about where silver goes before Monday's open. Silver crashed 38% from its all-time high of $116. In a single trading day last month, silver dropped 26%. The headlines called it a bloodbath. Western analysts declared the precious metals rally was over. CNBC ran segments about silver being overextended. Bloomberg published charts showing momentum indicators had broken down. But something strange happened in the physical market. Or rather, something strange did not happen. The crash was supposed to bring physical premiums back to earth. When paper price drops, the gap between paper and physical typically narrows, dealers cut premiums, supply loosens. That is how it has worked in every correction since 2008. This time, the opposite occurred. Dubai premiums went from 16% before the crash to 23% after. Shanghai maintained a 10% premium over the London fix throughout the entire sell-off. Indian import premiums on gold expanded despite gold falling from near 5,500 to 4,686. The paper market crashed. The physical market shrugged. And if you understand why, you understand everything about where silver is heading next. Let me give you one more number before we go deeper. The gold to silver ratio right now is sitting near 63 to 1. That means it takes 63 ounces of silver to buy 1 ounce of gold. Historically, when this ratio compresses during a bull market, silver outperforms gold by multiples. And right now, the physical market is telling you that compression is coming because the premium on silver in Dubai is proportionally larger than the premium on gold. Smart money in the East is paying more aggressively for silver than for gold on a percentage basis. That is a signal. Subscribe right now and hit the bell because what I am about to show you is the kind of data the mainstream financial channels do not cover. We track the vault data, the geographic premiums, and the institutional flows every single day so you never miss a signal. Let me start with the number that changed my entire framework for this crash. Dubai's physical silver price this week is $91 per ounce. COMEX settlement price is $73.75. That is a $17.25 gap. In percentage terms, 23.4%. Now, here is where it gets interesting. 3 months ago, when silver was trading above $100 on COMEX, the Dubai premium was only 8%. The paper price was higher, and the gap was smaller. Silver crashed 38% on paper, and the premium nearly tripled. Read that again. The paper price collapsed, and the physical price barely moved. Why would bullion dealers in Dubai maintain a $91 price when the global benchmark says 74? These are not unsophisticated market participants. Dubai is the 3rd largest physical gold and silver trading hub on the planet. They move billions in physical metal every month. They are not paying a premium out of sentiment. They are paying it because the physical metal is that scarce at the wholesale level. And think about what this means for every Western investor staring at their portfolio right now. Your screen says silver is worth $74. But if you tried to buy a 1,000-ounce bar for immediate delivery in the physical wholesale market, you would pay closer to $90. So who is setting the real price? The exchange that trades 200 paper ounces for every physical ounce delivered, or the market where actual metal changes hands? Now let me show you the East versus West divergence, because this is where the data becomes undeniable. The Shanghai Gold Exchange has maintained a consistent premium over the London Fix for physical silver delivery. The current Shanghai premium is approximately 10%. That is lower than Dubai. But here is the critical detail. Shanghai is the world's largest physical delivery market for precious metals. When metal trades on the Shanghai Exchange, actual bars move from vaults to buyers. This is not paper speculation. This is metal in motion. And the People's Bank of China has not stopped accumulating. Chinese central bank gold purchases have continued for 18 consecutive months. Total central bank gold buying in the first quarter of 2026 is on pace for over 350 tons, which would put the annual total above 1,400 tons. That is a 30% increase year over year. But here is what most Western analysts completely miss. The majority of that buying is happening in Asia. China, India, Singapore, and Middle Eastern sovereign funds are the dominant buyers. They are buying physical metal and paying whatever premium exists in their local markets to secure delivery. If this data surprises you, hit the like button right now. Most people watching financial channels this weekend have no idea this divergence exists. Meanwhile, on the COMEX side, the registered silver inventory tells a completely different story. COMEX registered silver has been declining steadily. Vault levels are under sustained pressure from standing delivery requests. For context, registered inventory represents the metal that is actually available for delivery against futures contracts. When registered inventory drops while open interest stays elevated, the leverage ratio between paper claims and deliverable metal stretches, and that ratio is stretching right now. The paper to physical leverage on COMEX silver is at levels that historically precede sharp upward repricing events. There are far more paper claims on silver than there is metal sitting in registered vaults ready for delivery. That imbalance cannot persist indefinitely. Let me put a finer point on this. The Silver Institute has documented 4 consecutive years of structural supply deficit in the global silver market. More silver is being consumed by industry, investment, and jewelry than is being mined and recycled. Over 200 million ounces short per year, 4 years running. And the COMEX vaults are supposed to be the buffer, but the buffer is shrinking while the deficit is growing. At some point, the paper market has to acknowledge the physical shortage that every Eastern buyer already sees. Now here is the pattern interrupt that should make you sit up straight this weekend. The Iran war escalation should have sent precious metals soaring. Silver is supposed to be a safe haven. Instead, silver crashed 8% in 48 hours during the escalation. That makes 0 sense on the surface, but it makes perfect sense when you understand the mechanism. COMEX raised margin requirements during the volatility. Higher margins force leveraged long positions to liquidate. Forced liquidations cascade into more selling. The paper price crashes not because physical demand disappeared, but because the paper market's own mechanics forced the sell-off. Dubai did not raise margins. Shanghai did not force liquidations. Their prices held. The crash was a paper market event, dressed up as a real market event, and the 23% premium in Dubai is the proof that physical buyers saw through it immediately. Let me put this in perspective with gold, because the same pattern is playing out across both metals. Gold hit near 5,500 at its all-time high and has pulled back 16% to 46.86 on COMEX. But India is paying a $350 premium per ounce over the COMEX spot price. Indian dealers, with access to the world's second largest gold-consuming population, are voluntarily paying more than the so-called global benchmark. The Swiss refinery data confirms the direction of flow. Switzerland processes roughly 60 to 70% of the world's gold. Swiss customs data shows gold exports to China, Hong Kong, and Singapore have increased by 43% year over year. Exports to the UK and US have decreased by 28%. The physical metal is making a one-way trip east. And the refineries are working around the clock to recast 400-ounce London good delivery bars into 1 kilogram bars that meet Shanghai Gold Exchange delivery specifications. When refineries are permanently reformatting Western bars for Eastern markets at record pace, that tells you exactly which market is gaining pricing power. The silver market is following the same structural path. Physical metal is flowing from west to east. Paper prices are set by leveraged futures positions that can be crashed with margin hikes. Physical prices are set by actual buyers who want actual metal, and right now those two prices are diverging by 23%. So here is the question nobody in the Western financial media is asking this weekend. If Dubai, Shanghai, and Indian markets all refuse to reprice silver and gold downward after the crash, what happens when Monday's COMEX session opens? Do the physical markets capitulate to the paper price? Or does the paper price eventually get pulled up to meet physical reality? Historically, when physical markets and paper markets diverge at this scale, it is the paper price that capitulates, because at the end of the day, you cannot deliver a futures contract to a central bank vault. They want the metal, and they are proving every single day that they will pay whatever it takes to get it. The last time we saw a sustained geographic premium of this magnitude was the late 1960s when the London gold pool was collapsing. European central banks tried to maintain an artificially low gold price through coordinated selling. The price in physical markets kept rising above the official rate. The pool collapsed and gold repriced from $35 to over $800 within a decade. If you are stacking silver right now, you are accumulating an asset that physical buyers in Dubai would pay $91 for today. Your cost basis at the COMEX price of 74 is effectively a 23% discount to the international physical clearing price. On a 100-ounce position, that is a $1,700 gap between what your screen says and what the physical market would pay. On 500 ounces, that is over $8,500. Let me give you two scenarios. Conservative scenario, the Dubai premium narrows from 23% back to a normal 5% range. That means either Dubai comes down or COMEX goes up. Given that premiums widened during the crash rather than narrowing, the more likely resolution is COMEX moving toward physical pricing. A 5% premium on the current Dubai price implies a COMEX silver price of roughly $86. That is a 16% gain from today's 74. Bullish scenario. The structural deficit continues, COMEX vault levels keep declining, and the premium widens further as Eastern buyers accelerate purchases ahead of the next geopolitical escalation. In this scenario, silver retests the $100 level on COMEX, and the physical market prices even higher. On a 100-ounce stack at $74 cost basis, that is a $2,600 gain in the conservative case, and a $2,600 to $5,000 gain in the bullish case. The signal to watch is the next COMEX registered vault report and whether the Dubai premium widens or narrows. If it widens further, the paper price repricing event is closer than most analysts think. There are three types of people watching this video right now. The first type saw the 38% crash and panicked. They sold at the bottom or they are thinking about selling. The second type is confused. They see the paper price crashing, but they hear about physical premiums and they do not know what to believe. The third type understands exactly what is happening. They know the paper price and the physical price are telling two different stories, and they are positioned on the right side of that divergence. Which type are you? Drop it in the comments. If you want these vault data alerts and geographic premium updates before the mainstream catches on, subscribe and hit the bell. We track this data every single day. Watch this next video where I break down the COMEX vault numbers in detail and what the registered inventory trend means for silver's next move. Not financial advice. Always do your own research before making investment decisions.